Hello, everyone, and thank you for joining us during the Lytham Partners Winter 2023 Investor Select Conference. My name is Roger Weiss, and I'm a Vice President of Lytham Partners. In this presentation, we welcome Aytu BioPharma, NASDAQ symbol AYTU, and with us today is their Chief Executive Officer, Josh Disbrow. Before we begin, I want to remind everyone that management is available for one-on-one meetings later this week. If you've not already signed up, please send me an email at weiss@lythampartners.com or visit www.lythampartners.com/virtual and click the one-on-one meeting request button. All right, Josh, let's begin. Josh, could you please introduce yourself and give us a quick overview on Aytu?
Yeah, happy to. Hi, Roger. Great to be with you. And thanks to Lytham for the invitation to present and to be with you here for this fireside chat. I'm Josh Disbrow, co-founder, chairman, and chief executive officer of Aytu BioPharma. We're a commercial stage pharmaceutical company. We compete in both prescription and consumer health segments. Our prescription segment is focused primarily on pediatrics with a distinct focus on ADHD and general pediatric conditions. Our consumer health segment is focused on value brands that compete with large national brands. And these brands that we sell are primarily sold through e-commerce on the Amazon platform and are sold at a substantial discount below the major national brands. Our trailing 12 revenues are in excess of $100 million. The company just generated its first profits last quarter, having generated being EBITDA positive for the September quarter for the first time in the company's history. So we're very excited about that and very proud about that, and certainly happy with what that signals for our go-forward growth plans. Our growth is largely being driven through prescriptions and through consumer products. On the prescription side, we're largely experiencing growth of our ADHD brands and our pediatric brands. And we have a program called RX Connect, which we'll speak about a little bit later, that's really catapulting our growth and is a great platform for further growth, additional product acquisitions as well. And so looking forward to that. The growth on the consumer side is largely being driven by organic growth as well as new product additions as we put them into the portfolio and sell those through e-commerce. And we expect to drive additional top-line growth as we grow. Both organically and again through potential new product acquisitions on both sides of the house, and we're improving margins dramatically, and we'll talk to that a little bit, what our plans there specifically with respect to getting our margins improved to continue to generate EBITDA and ultimately cash flow. So at a really good position. If people are hearing the story for the first time, it's a really exciting time for the company as we've begun to cross the chasm towards profitability, reduce our reliance on the capital markets, and significantly reduce our cash burn. So it's a good time to be sharing the story.
Thank you. Josh, this past fall, Aytu announced its change in what was a dual strategy of both commercial operations and drug development to focus solely on the commercial business. Can you review the circumstances that were the catalyst for your decision and where the company is currently positioned now?
Yes, and what I'll first say is the company is really well positioned now that we've made the pivot and have begun to focus exclusively on commercial operations. Look, it's no surprise to anyone that fiscal calendar 22 and our fiscal 22 into our fiscal 23 has been a challenging time from a capital markets perspective. So market factors really largely caused us and many companies to look at their business and really look at their cash burn, and particularly cash burn attributable to R&D, and see what needs to be trimmed. And so we made the important, albeit difficult decision to stop and indefinitely suspend our pipeline development, most notably of our rare disease asset that we call AR101. And we did this based on the need to focus on our core capabilities and focus our resources on commercialization, and spending time and spending our money on the most critical value drivers, which we believe is generating profitability in the near term. Following that time, we'll be able to pivot back and I think reinitiate our clinical work. That having been said, the time is not now to do that. The time is to focus on commercialization, to focus on the value drivers that are going to lead to top-line revenue growth and ultimately driving us to profitability. So what's great about this pivot, while it was a difficult decision, is we can now very clearly see profitability from here. It's an exciting prospect for the company to now have just posted its first EBITDA positive quarter for the quarter ending September 30th. And we've got great momentum within the business. We've got significant growth, we think, ahead of us due to numerous market factors and just what we're doing operationally. And so we need to show the market and show everyone that we can excel, excuse me, even in a difficult environment, which persists here into calendar 23. Again, I think we can see profitability from here, EBITDA positive, about 1.4 million positive for last quarter. We expect to continue to post more quarters like that, not necessarily signaling exactly what those will look like, but we are very comfortable that our burn has come down tremendously. Company actually is very well positioned with cash, having posted 23.8 million in cash as of the end of September. And that actually was including a fair amount of R&D spend, because we really had not fully pivoted until after that quarter that ended in September. So on a go-forward basis, we expect to significantly reduce our R&D burn. There will be some wind down costs and some sort of exit costs, but outside of that, we really expect spending on R&D to be de minimis. And again, we'll hope to revisit R&D spending as we get to cash flow and as we begin generating meaningful cash reserves. But in the near term, it is all hands on deck to drive top line growth and EBITDA and profitability, and that's what we're poised to do.
That's great. Maybe I could ask kind of a follow-up to that one. You're generating $100 million in revenues annually, which is a pretty impressive number. Can you talk about where that's coming from, the operating segments, the respective products of those segments, and more importantly, how you think about marketing and driving future sales growth?
Yeah, happy to. So that roughly $100 million in trailing 12 revenue is split about 65-35 as a percentage. 65% or so is our prescription business, and the remainder is our consumer health business. The prescription business is comprised of 5 key brands, 2 of which are for ADHD and 3 of which compete in general pediatric wellness categories. The ADHD medicines are Adzenys XR ODT, which is a proprietary orally disintegrating tablet formulation of amphetamine. It's the only ODT extended release amphetamine anywhere on the planet. So it's very unique in that it dissolves very rapidly, but lasts a full 12 hours, competes in a large category of nearly 80 million prescriptions annually, competes with the likes of a product like Adderall XR, which you've heard quite a bit about here in the news lately, particularly the fact that it's been in short supply. And then we have another orally disintegrating tablet called Cotempla XR ODT, which is a methylphenidate that competes with Concerta, and it's also a very, very big category. So we essentially cover the waterfront on ADHD and competing in the very, very large stimulant category. It's a category that continues to grow double digits on an annual basis as a percentage. And there's really no let up in sight with the increased diagnoses around ADHD. And so we're well positioned in these large growing markets with very novel, very unique ODT formulations of these tried and true molecules. On the pediatric side, we market a brand family called Poly-Vi-Flor and Tri-Vi-Flor, which are multivitamin combinations that contain fluoride. And these are prescribed for patients that live in areas or do not get enough fluoride in their diet. And so it is a fluoride-based multivitamin supplement that are branded and that have unique attributes. And then we market a product called Carbinol ER, which is an extended release, first generation antihistamine. And it's a workhorse antihistamine that's really for patients that continue to have allergy symptoms when OTCs like Zyrtec and Claritin don't work. So those are all tried and true molecules, tried and true products, and they're all competing in large markets that continue to grow, and these have distinct features and benefits for patients that are well characterized. On the consumer side, we have a wide array of consumer health products, but most notably a line of OTC medicines that we sell largely through Amazon. And these are products that compete with the likes of major brands like Flonase and Prilosec and Prevacid and Rogaine. We have our own versions of those products, and they compete largely on price. And so think of these really as value brands similar to Good Sense or Equate. So for patients that are looking for Rogaine, that are looking for something in this day and age, even pennies cheaper for a month's supply goes a long way, because obviously we know we're facing a relative economic hardship in a time of uncertainty, and these products are very well positioned as lower cost alternatives to more expensive national brands. Same molecules, same product, but really competing on a lower price. And so that business segment has grown nicely, and we continue to expand that portfolio with other similar products that compete in different categories, but large categories, and would compete largely on price. And so we'll drive growth on the consumer segment through continuing organic growth of our established product line of these value brands, while we bring on additional products and add those to the portfolio and compete in large categories like aesthetics and hair growth, like allergies, and like gastrointestinal, and continue to compete with again the major large national brands like Prilosec and Prevacid. On the RX side, we'll continue to grow largely through organic growth and through the leverage that we have through our proprietary pharmacy program that we call RX Connect, which we'll speak about. Really an exciting program, a lot of intricacy to it, but it brings a lot of value and really creates a win-win-win, a win for the patient, a win for the clinician that prescribes our products, and of course a win for Aytu in that these products are taken for longer periods of time. The margins are actually higher. So we'll spend a little bit of time talking about the benefits and really what RX Connect is.
Got it. And you briefly touched on it, but I think it's fair to say that the current economic consensus is that we are in, or will soon be in, a recession. How do you expect both operating segments to fare in an economic downturn? And do you see it as a challenge or an opportunity at this point?
Roger, this is a real opportunity for us as a company across both segments of our business, both the prescription segment as well as the consumer segment. And I really say with enthusiasm that the company and our products are positioned very, very well. We expect both to fare well really through any economic environment, but most notably during a downturn. And I say that because our product lines, both RX and consumer, exist at this perfect intersection of creating value and access for patients and healthcare consumers. And what I mean by that is right now there's a huge challenge in the pharmaceutical market in general, in that patients have a difficult time simply getting access to their medicines, whether that's through difficulty with getting their insurers or their PBMs to pay and sort of rebate and pass on rebates from the manufacturer to the patient, or whether it's the pharmacy that actually has the prescription product in stock and is able to deliver it to that patient that day or the following day. And so on the RX side, RX Connect really stands to separate us distinctly, and it offers several things to the patient, one of which is guaranteed access. If a physician prescribes one of our prescription products and sends it to a partner pharmacy, the patient's parent will get a guaranteed copay not to exceed a certain dollar amount, depending on the brand. It will be guaranteed in stock, and it will be available for in-person, in-store pickup, or potentially delivery to their home or office. And so that's a huge step above what really is available anywhere else through a standard retail pharmacy play. And so that's really a great way to create certainty for the patient in terms of copay, certainty for the patient in terms of that they can actually get it, and comfort in that copay is going to be consistently applied. On the consumer side, again, we really orient, and our thesis around the consumer segment is delivering value for patients, lower cost alternatives to large national brands like Flonase, Rogaine, Prilosec, and Prevacid. If you go on Amazon today, you can bring up any of our brands and you'll see that they're all priced lower than the national brands. And that's a huge value at a time when people are looking to save even pennies on, say, a month's supply of Rogaine. We can win there. We can help patients win. We can help patients save money with an alternative product that's just as good. In some cases, patients might actually give superior reviews versus the major national brands. And so, again, we compete at this perfect intersection of value and access on both sides. And that's so important for patients, whether they're picking up a prescription product or they're buying a consumer health product, but that for something that they can treat themselves, like allergies, hair growth, et cetera. So really, to recap, high level of enthusiasm and excitement for where we can exist today, where we compete today in a challenging environment. And even as we come out of these challenging times, we hope towards the latter half of calendar 23, we'll continue to be even better positioned as we think about patients that have come to us at this earlier part of the year when they're looking for, again, value and access. So excited about how we're positioned.
Very good. And just in terms of the Aytu's RX Connect, specifically, you mentioned the early part of the year, people are going through their deductibles, et cetera. How does the RX Connect help people with that kind of situation?
RX Connect really exists as a total solution for patients that are seeking our branded medications. And frankly, the potential benefits down the road for RX Connect extend beyond even our prescription brands at Zenis, Cotempla, Polybiflor, Tribiflor, and Carbinol ER. It's a total solution for patients that are seeking, again, they're seeking certainty, they're seeking stability, they're seeking consistency, and they're seeking to minimize the hassle. And we do that for the patients, the parents, the prescriber, and really everyone along the value chain to enable value in that they get a product that essentially we will underwrite if we have to. And when I say that, we will essentially this time of year buy down the copay if in fact the patient is in their high deductible period. And that is of huge value because if a patient is, for example, getting a prescription filled in November or December, having already met their prescription drug deductible, their copay may be something in the lines of $35 or $40. You flip the calendar to January 1st and you go to pick up your prescription at a neighborhood, a large big box store, and that copay may be something approximated $300 or $400. And the reality is you won't know until you get there in many cases. And you won't know for many reasons. Most notably, it's how the PBMs work and the resetting of this deductible happens on the calendar year. And so it creates sticker shock that presents itself in real time to the mom or dad or whoever's buying that picking up that prescription. What we offer through RX Connect is a network of pharmacies that we are aligned with. We don't own these pharmacies. We don't have any formal relationships with these pharmacies, but they essentially participate with us. And through a combination of multiple inputs, data analytics platform, understanding how reimbursement works at the individual transaction level, a full suite of package and data warehousing capabilities that enable us to have a very, very fine-tuned understanding of exactly what the patient is paying, what the pharmacy is making on that claim, and ultimately enabling a smooth, seamless, frictionless transaction for the patient to say, here's your prescription of Zenis XR ODT. It's $35 guaranteed every single month, and sometimes it's even lower than that. So for all commercially insured patients, we essentially serve as an underwriter to those prescriptions to guarantee no negative feedback to the patient at the point of sale, no negative feedback from the patient back to the physician that their copay caused them sticker shock and therefore caused the clinician a hassle to have to either write something else or potentially stop writing a product altogether. And it removes hassles of things like prior authorizations and step edits, because essentially we serve as the underwriter for the prescription to take all of that friction out of the system. And what do we get in return? We get a loyal patient. The pharmacy gets a loyal family and potentially more prescriptions beyond just their ADHD medicines. The physician gets a hassle-free prescribing experience and no callback, so no negative feedback loop. And ultimately, we as Aytu get a high-value patient, a high-value prescription, and more longevity and higher levels of adherence for these patients that are staying on their medicines longer. And by the way, we make higher margin on those on average versus what we call a free-range prescription that could go just to any big box store. So it's a win-win-win-win across the board, across the spectrum of the value chain. We make more, we keep patients on our therapies longer. The patients benefit through their certainty of copay and ultimately everything that really surrounds sort of their experience, and the physician and his or her office staff benefit by minimizing the hassle and actually getting the brand that they prescribe filled in a timely, efficient manner. So it's a great program. It's a lot of back office work that has to go into this, but we're happy to do it for the benefit of the patients, and it ultimately does benefit our bottom line.
Very good. One of the things that we've kind of talked about is your focus on pediatric therapies and specifically ADHD. During 2022, the sector was repeatedly in the headlines as many of your competitors seem to be having trouble getting products to market. How do you think about the supply disruptions that many of the ADHD patients felt? And do you think there's going to be any lasting impact on the category's historical double-digit growth that you talked about?
Yeah, great question, and very timely, because even today we're hearing not just about shortages of Adderall and Adderall XR, we're actually now hearing potential issues around methylphenidate, Concerta specifically, which is, of course, the other side of the stimulant market. And you're exactly right. Through the latter half of 2022, there were repeated articles in the US and actually even several in Israel speaking to the shortage around Adderall XR, which is the leading brand in the amphetamine, the extended release amphetamine category. Actually, both the immediate release as well as the extended release reporting intermittent supply disruptions from some major manufacturers like Teva. So it created a huge sense of discomfort for the patients and physicians, to the point that physicians are having to look for alternatives. And the reality is these are disruptions, particularly now that we're hearing about methylphenidate just now, these may linger well into calendar 23. And that's a huge opportunity for both Adzenys and Cotempla, because they are really substitutable in many ways. While not technically substitutable at the pharmacy level, they are bioequivalent, and they are, in the case of Adzenys, amphetamine extended release, and in the case of Cotempla, methylphenidate extended release. So we have an opportunity to wear the white hat and be the white knight, so to speak, in bringing these alternative products that are available in these nice formulations, these ODT forms, to essentially replace, in this case of shortage or supply disruption. And we've already seen really nice uptick. Our Adzenys XR numbers are at all-time highs, really coming out of calendar year 22 and into 23. Cotempla now may get some tailwinds on the basis of some of these reported issues around methylphenidate and the Concerta shortages. And what's important here is these are bioequivalent to essentially the standard medications. Adzenys is, again, bioequivalent to Adderall XR. Cotempla is actually bioequivalent to an extended release methylphenidate called Metadate CD, which is very similar to Concerta. And so we've got an opportunity to step in and essentially realize, we think, a step function in our prescription levels by virtue of getting new patients on therapy that we otherwise wouldn't have. And what's nice about a chronic medication, of course, from the company's perspective, is those patients will stay. Those patients will stay on Adzenys or Cotempla. That becomes an annuity to us. And that's a patient that, again, we wouldn't have otherwise gotten. So call it a step function, call it a shift upward. But what we're seeing is really nice momentum in our prescription trends, attributable to, in part, this shortage, also in part to the continuing execution we have with our field force doing a great job getting in front of their prescribing customers. And you couple that and marry that with the leverage that we gain through RX Connect, and it creates really a nice opportunity for growth for us. So we're taking advantage of this relatively short-term opportunity. Do expect it to linger for long enough for us to, we think, gather more patients than we otherwise would have, and get new patients on therapy, and really give them the benefit of these novelly formulated stimulants. So it's really while it's not an ideal scenario for patients, we have the ability to step in and really help solve for a big part of this, and are happy to do our part.
Okay. Part of your focus on the commercial operations has been to improve operating margins through the outsourcing of the ADHD manufacturing to a third party. Can you give us a status update on your progress and what your expectations are in terms of for improvement of the margins at the ADHD level, as well as from a corporate level?
Yeah, we're making great progress, and we've made it known, Roger, as you know, that we've made a strategic decision to discontinue manufacturing at our own facility in favor of outsourcing to a contract manufacturer. And it's a US-based manufacturer. It's a global CDMO with whom we've had a relationship for quite a while. And I'll say the progress it's going well. The process is underway. There is a process that you need to go through, inclusive of completing bioequivalence of product A versus product B, so product manufactured at our current facility versus product that will be manufactured at the future facility. That is underway. There's a process following that whereby we'll have to submit to the FDA to get approval on the new manufacturing site for both Adzenys and Cotempla. And we expect that to wrap up this year, towards the end of this year, such that we would be manufacturing at the new facility, end of this year, early next, assuming that the FDA is able to accommodate their standard timelines for inspecting the new facility. The plant that we are moving these to hasn't been inspected for a couple of years, so we are expecting them to have to formally inspect the plant, which is standard fare anytime you're doing a site transfer. And so that's all underway. It's going well. Really, really compelling economic story here with respect to margin improvement. We would expect a near immediate step change in favor of gross margin improvement on the other side of this transition, upwards of 15 to 20% on the ADHD lines. And if you keep in mind that that's roughly half of our $100 million in revenue, That's essentially a 7.5 to 10% margin improvement sort of across the portfolio from a blended perspective, taking again 15 to 20% of half of our revenue, and so it yields a almost 10% margin improvement right to the bottom line. And so as part of our plan when we acquired Neos coming up on 2 years ago, it was to streamline commercial operations, which has been done, streamline internal operations, which is being done, and with the ultimate catalyst really being finishing the transition out of Grand Prairie in favor of the CDMO outsourcing model, and that is in kind of the final inning. So excited about that. While it's difficult to let people down and shut facilities down, it is far better for the benefit of everyone, most notably the patients, such that we can continue to deliver value to them while driving better margin for the company, such that we can continue to drive growth, drive cash flow, with that cash flow ultimately enabling us to invest in new product opportunities, whether those are commercial stage opportunities or whether that enables us to reignite our AR101 R&D program.
So this really is something that's going to move the needle when it's finally done, I think, as you said, toward the end of the year.
It really should. I mean, we see this again as a step function, as a dramatic, near immediate, and when I say immediate, of course, you're going to have to begin manufacturing and wind down things, but really a significant step change in favor of margin without any disruption at all, obviously, and it's going to reduce costs in a major way. It's going to trim headcount. It's going to streamline the organization. It's going to really give us an entirely new look. So we will have fully virtualized the company, really put ourselves in a situation where we now outsource manufacturing of all of our products, and we are solely now on the focus of commercializing products in a more virtual setup. We will focus on what is core, which is not manufacturing. It is identifying and bringing products into the portfolio, growing those products through our infrastructure and network, and then again accelerating R&D at the appropriate time. And again, that's only going to be when we can drive cash flow to enable that funding.
Got it. Besides the strong organic sales that we've discussed, is there a place in your future for product acquisitions? And if there is, could you kind of describe them in a generic way, what you would look for and how you might value it?
There's an opportunity for new product acquisitions, particularly revenue stage, commercial stage assets. But to be clear, we would not be favoring any deal right now that requires us to take any meaningful cash off the balance sheet. So we would be looking for products that we can tuck in neatly into the portfolio that fit one of two categories: either a product that fits within our therapeutic footprint vis-a-vis ADHD, pediatrics, psychiatry, understanding psychiatrists do prescribe ADHD medicines, as well as pediatricians and family practitioners. So we would look at a commercial stage asset that could be sort of aligned to that call point, so our sales force could potentially fit that into the bag. But then there's the benefits that we have with RX Connect that is really a pharmacy play. And there we would look for, again, not products that we would pay big upfronts on, but products that could fit into our network and could potentially be small brands that compete in large therapeutic categories that the pharmacies are filling already, but they may be filling generic. So we may have an opportunity to introduce brands that the pharmacies can fill, particularly if those brands have reimbursement and we're able to sort of optimize the economics for the patient as well as for the pharmacist. And so those are the types of things we're looking at. We're having active discussions. We actually brought in an ADHD product that we would largely run through the channel, or largely run through RX Connect without a lot of Salesforce promotion. And so the types of products we would bring on would be minimal upfronts, would not require any or only minimal kind of commercial scaling. So we wouldn't add reps to promote these products. We wouldn't have to bring on any additional infrastructure in terms of fixed costs. So low cost, low risk, nice upside types of opportunities that we can tuck into the program.
Very good. I'm seeing that we have a couple of minutes remaining. Could you just talk about the current state of the company, the future, the value drivers here, and really what excites you most about the company's future at this point in time?
I'm excited, Roger, about the fact that we really have control back in our hands. We are not going to be subject to the whims of the capital markets. We're not going to be subject to some of the market dynamics that affect branded pharmaceuticals, because we've taken that control. We've taken cash burn largely off the table by virtue of halting the R&D programs, and we've taken sort of the commercial risk out of the equation by virtue of the RX Connect platform, through which we run over 90% of our prescriptions. So I'm excited about the ability for us to sort of dictate our future. I'm excited about the fact that we're hitting all-time highs with our particular ADHD meds, as well as our multivitamin line. And I'm particularly excited about we're doing this all with a newly streamlined, consolidated cost infrastructure, with more plans ahead to further consolidate expenses and drive margin improvement. And in the far future, as we're cash flowing and building cash down the line, the ability to build through additional acquisitions, accretive acquisitions, and the ability to reignite the pipeline at the appropriate time. No plans until we're cash flowing, but cash flow is now in sight, and super, super excited about that.
Very good. I guess at this point, Josh, I want to thank you very much for your time today. We greatly appreciate it.
Thanks, Roger. Thanks for having me.
Again, to anybody out there who is not already signed up for a one-on-one, please feel free to send me an email at weiss@lythampartners.com or visit us at www.lythampartners.com/virtual and click on the one-on-one meeting request. We hope you all enjoy the conference.